We're here just to have a conversation. We're not official advisors. So the legal disclosure says real estate investment results, its officers or members provide no legal or professional advice. You should always consult a licensed professional, a professional appraiser, real estate agent, or financial advisor when making any decisions regarding the purchase and sale in real estate. The information obtained from reir.co, real estate investment results, or its members is intended solely as general guidance, and exchanging, buying, or investing in real estate and does not constitute legal, financial, tax, appraisal, accounting, or other professional advice. Because real estate contracts, closing procedures, disclosures are guided by state law, always consult a local professional when engaging in a real estate transaction. And that is the disclosure. So again, Joshua Dudgeon, if you want to check us out, our website is reir.co. The long URL is realestateinvestmentresults.com. The short one is just the first letters and .co. And then we are operating most of our deals around La Crosse County. Like I said, I'm in a couple of national groups, so we will be doing a lot more national level deals, mostly land deals, but there's going to be some strip deals as well. And we're also looking in the self-storage market as well. So welcome today. And we are going to talk about the real estate shortage. And I don't know if you've noticed, but business is booming for people that are trying to sell houses. I was just talking about my sister. She bought a house 45 days ago or 60 days ago, and she can't close because the seller won't get out because they have no place to go. And they paid her $1,000 for last week, and I don't know what's happening this week. And that isn't actually our market. She moved away to Colorado and just moved back. So she's actually staying with my father right now, and she's wearing out her welcome quickly. He wants his house back. We were just kind of having a laugh about that. But today we're going to talk about the shortage. Where did the shortage begin? Well, if you remember the crash of '08, which rocked the world, that was a 100-year event. What that means is, as a matter of fact, if you own any property in the floodplain, that floodplain is always based upon the last 100-year flood, which is the largest flood in 100 years. That 100-year event is the largest event in 100 years, and it was caused by some real issues in the marketplace. It starts, and it seems like it always starts with the big word government. There's a famous phrase that says, I'm from the government and I'm here to help, the scariest words in the English language. But anyway, back in 77, there was a law passed called the Community Reinvestment Act. And what was occurring back then was there was a problem in low-income areas that they're having trouble getting financing because bankers in general are conservative beasts, and so there was very little lending going on in low-income housing. So the government stepped in 1977, this is during the Carter administration, and passed a law called the Community Reinvestment Act. And what that did was say, bankers, you need to start lending into these lower income areas. And by the way, we'll help you out by kind of giving you some reassurance, and that we'll make sure that you don't get hurt. And really, Fannie Mae and Freddie Mac, if you're familiar with those two, so I don't know what they're called, they're letters put together, but those two banking juggernauts are quasi-government companies. And I found out in the last 3 years that there isn't actually a document that ties into the government, but they are backed by the full faith and confidence of the federal government. So what ended up happening was those entities would buy up mortgages because bankers were lending and creating this, what they call paper, and selling it, and Fannie Mae and Freddie Mac were buying it up. Now, it wasn't that big of an issue at the beginning because it took a long time for that 2008 crash to really percolate. And in 1995, during the Clinton administration, they revised that Community Reinvestment Act. They did a rewrite of it, and they kind of expanded and loosened the controls of it. And so that Community Reinvestment Act expanded during the Clinton administration. But I know it sounds like I'm beating up on Democrats, and I'm not. because it really didn't become a big problem until the Bush administration. So what happened during the Bush administration? Well, the Bush administration, we know, was when 9/11 happened. When 9/11 happened, we decided to go to war. And if you pay attention to what's going on right now, they're expanding the debt ceiling. And that debt ceiling is where the government basically is printing money, but they have to be allowed to print money. And it takes the Congress to actually allow them to do this. And when they do that, they base it all on what's happening in the economy and how much the debt ceiling can handle. And it's very complicated, but the long and short of it is during the Bush administration, when they started on the war, they had to put the war on the debt ceiling, the credit card, and Bush was selling the war cost on the fact that the housing was booming and that the economy was doing great because of housing. So since the administration was saying housing was so good, it caused the stuff that was in the Community Reinvestment Act to kind of go on steroids. So it got crazy from about 2003 to 2005, where there is situations where there was a thing called a no-doc loan. And I actually was not in real estate yet, but I was studying real estate at the time, and I was paying attention to what's going on in the marketplace. And one of the things that happened in the real world, it's an anecdotal thing. There was a woman I knew, and she bought a condo in Chicago, and I knew that there was no way that woman should ever have bought a $250,000 condo in Chicago based on what she had for skill level. I didn't know what she got paid, but I knew that her income could never have been high enough to cover that number. Not only did she buy a $250,000 condo, but they gave her $50,000 at closing in cash for herself and put it on the loan. That was what was going on in 2003, 2004, 2005. Why was it happening? Because the paper that was being written was actually being sold to Fannie and Freddie, and it was being backed by the government. And then there were a couple of different things that occurred. They were boxing these mortgages up, and they were selling them off in 1,000-unit groups, and that was called a mortgage-backed security. And then those securities were being bought by pensions and basically retirement projects, whether they were like a lot of more teachers' pensions, firefighters' pensions, but they're also bought by the mortgage or the JP Morgan Chases, Bear Stearns, these companies that would buy them, and then they're making a percentage of money because they buy these big packages. Well, the problem was, and the law stated at the time that you could not take that 1,000-unit and look at the individual people and find out which one were the bad ones and pull them out. So you could only look at the packages as in 1,000-unit packages. So the smart companies, and this is really when I say smart companies, we're talking about the JP Morgan Chases. Since they couldn't look at the individual people, what they did is they created algorithms, hired these genius Harvard kids to create algorithms, and then they were able to predict the paper that was bad, the mortgages that were likely going to fail. And what they did is they bought these big packages. They would figure out via an algorithm which ones were the good ones, which ones the bad ones. They take the bad ones and they'd stuff them into another unit of 1,000. And I'm dumbing this down quite a bit. There's more detail to it than this, but I'm trying to make it as simple terms as possible. And then they would sell them off. Well, who was buying these in the marketplace? Who was the people that were buying them? Were generally people that were less sophisticated, which were your pensioners. The unions were buying into, like a lot of, like my wife was a teacher. The state of Wisconsin has a health insurance plan, and they have a retirement plan for their teachers. The interesting part about Wisconsin was Wisconsin's retirement plan actually was the money that was for the teachers, was their own health insurance. So they back each other. Well, they still have to be backed. Insurance companies buy these packages. Well, they're places to store money that's going to grow slowly over time, but securely. But when the JP Morgan Chases of the world figured out what the bad packages were, they then handed them off, because these other people that weren't sophisticated to know they're buying bad paper, were buying them and sticking them in the portfolios. So not a problem when the whole market's going up, 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 but there was so much fraud and abuse. And there is actually a movie about this that I didn't watch for several years because I thought it was just going to be a hit piece that didn't make sense. And it's called The Big Short. If you go watch The Big Short, it is, I didn't watch it until like 2019, I think. And it is very accurate and very good at explaining what happened. And it was actually, I was impressed with how well they did putting what really happened in a movie. So if you want to watch The Big Short, that is the example. That is what I'm going through right now. I explained to you. So anyway, so it was all good until all of a sudden the truth started to come out where some of these people that were getting these no-doc loans, and not some of them, but lots of them, and there was fraud and abuse, a lot of fraud and abuse in the system as well. And it wasn't just the fraud and abuse here, it was fraud and abuse at that mortgage-backed security level as well. And it started to come unraveled. And once it started to come unraveled, what ended up happening was the pensioners were the ones that were going to get hurt. So you had people that were going into retirement and their pension was, let's say they were a teacher, and their pension was 50 to 60% invested in this bad paper. When the bad paper would come unraveled, that means that they were planning on retiring. Let's say they were going to get $300,000 in pension. So they're going to have a $75,000 a year retiree kick-out from their teachers union. All of a sudden, that teachers union pension is worth 50%. So now they're planning on living on $75,000. The teachers union can no longer pay them $75,000. They're going to pay them $35,000. So now they're just completely given the people that have done nothing wrong a haircut in the retirement. Long story short, they walk into the Bush administration right at the end of the Bush administration, right at the beginning of before Obama is taking power, and they say the economy is unraveling, and we need $1 trillion, or it was like 500 somewhere between 500 and $1 trillion worth of liquidity in the next few days, or the entire world's economy is going to come apart. And Bush said, I can't do anything about that. Go talk to Congress. They run over to Congress, and what's really funny is there's a whole documentary you can find online about this. But when they went to ask Congress for money, this is how unsophisticated it really is. And this is what's scary about the financial world. When they went to ask the Congress about money, they actually made up a number to ask for. And I think, if I remember right, and numerology is a real thing, which means the value of numbers and the placement of numbers. They went and asked for, I think it was $787 billion. Now, why they asked for that? They knew that if they asked for 500, it wasn't enough. And if they asked for $1 trillion, they would be laughed out of Congress. That 787 was enough to seem ridiculous, but not enough to not get a yes. And it was Henry Paulson and a couple of Timothy Geithner, and I can't remember the other guys, but there's 3 or 4 guys that went into Congress and after this, they said, by the way, if you give us this, stops the problem, it'll be over, we'll fix it, the bleeding will stop, the market will go back. But they were wrong. So Congress, and I think Pelosi was involved in this at the time, I can't remember exactly, but they signed off on it. They put this liquidity into the marketplace, $787 billion, and it goes out the door like that, and they're sitting there and the market's still bleeding. So then they go back and they have to ask, they said, well, what happened to that money? Well, it actually didn't stop the bleeding, and they were wrong. So when they went back to ask, they couldn't ask for another $1 trillion, so they knew that that wasn't going to work. So they went in and they said, what do you actually need to do? Well, what we need to do is we need to create an environment where, and some of these bankers were, their share price had gone from like $150 a share to $2 a share. And it was required, the positioning was that if they would only back some, the market would keep answering to who they're backing. So they put all these bankers in a room, and there is an actual video out there you can find on this. And they said, we need every single banker to ask for money. Every one of these big banks. A couple of, like, Bear Stearns was already out of business at this time. There was a couple of them that were on the way out. JP Morgan Chase, I don't think needed money at the time, but if they went and put them all in a room, they said, if you don't take money from the Fed today, or commit to take, they didn't take the money, they said, commit to taking money from us, the market will know which ones are weak and which ones are strong, and we will not be able to stop the bleeding. So they said, if you don't agree to take money from us today, because we need to go tell the market that everybody's agreed to take money, we're going to fix the problem. If you don't agree, when you come to need money, because the bleeding is not going to stop, we are going to tax you to death. So the funniest part about the whole thing, if you go find this video, this documentary, is when you and I go to the bank to get a mortgage, they give you a stack of paper and you turn it and you sign and you sign and you sign and you sign, right? The sheet of paper, I'm not kidding you, that these guys signed was this big. And it literally had a document that said, and they had to put their bank name in, JP Morgan Chase. And the line that they had to write the billions of dollars that they wanted to commit to taking was actually only this big. So they had to write 25 and then billion up at an angle on the document. So they were able to get the government to lend them billions of dollars with one sheet of paper. And you and I have to sign a book that says we're going to let you come take our child if we don't pay our mortgage. So the funniest part about it is in reality, the government got them all to sign, they needed them all to sign to stop the bleeding. And then what ended up happening was there were some banks that ended up having to buy other banks, and they stopped the bleeding. And then the quantity of upside down mortgages were still in the system. And so then they slowed down. So when Obama started, he got handed this big mess, and he's trying to fix it. And so what they did is they said, like, these banks are going to take it, and we're going to slow down the mortgage foreclosure process so that they don't have all the houses come on the market at the same time, which then slow down the process. Well, then in the context, while they're slowing down the market to solve some of this, they actually created a law called Dodd-Frank. So Dodd-Frank was, I think it was 2010 or 2011 when they put that through. Dodd-Frank was a kind of an overall banking change rule juggernaut law that stopped, or really didn't stop, but it slowed down. It penalized the banking industry. It made them reassess how they're banking. They couldn't buy high risky stuff anymore. But then the biggest thing it did for the mortgage industry, which is why we're talking about this whole thing today, is it slowed down the mortgage process, because there came a word which I don't agree with, but there came a word out of the banking industry called predatory mortgages. And like I said, when you go to sign a mortgage for your house, it's usually a stack of papers. I remember my first little $67,000 house. I couldn't believe how many times we turned pages and signed to just get this little tiny mortgage when I was a kid. Anyway, I guess I'm still a kid in some context. But no, the value of slowing down the system, then Dodd-Frank slowing down the system, was to try to keep a bubble from ever happening again. That was the Obama administration said, we want to never allow this to happen again. So they put these rules in place. So one of the rules that still is in place today, and every time we try to sell a house, we have to deal with it, is because of this concept of predatory mortgages, which if you sign all this paperwork, you know what you're doing. So that's why I have a problem with the word predatory mortgages. The concept of predatory mortgages, when you sign your mortgage, the Dodd-Frank rule makes you wait 4 days before you can close on your house. So you can close on the 4th day. So if you sign on Friday, you can't close till Wednesday. And we actually have issues with closing sometimes because they were supposed to sign on Friday. Something happened to the mortgage paperwork. They didn't sign until Monday, so now they can't close till Thursday. Actually happens occasionally. That rule was one of the things that Dodd-Frank did to slow down the system so that it would slow down predatory mortgages, which would slow down the problems. Well, there's a backlash to that, and that is over that 8-year period, because of those rules, there was less building going on and less building at a substantial rate. So the inventory needed to be used up, but then the inventory got used up. And where we are right now is we're on the back side of that. So if you look right now, you'll hear people saying like they can't find a house. I told you about my sister's situation. They can't. There's all these problems that are occurring in the marketplace on the other side of what happened in 2008, and that is a shortage of inventory. So the shortage of inventory started with the fact that there was this slowdown in the banking, and then when Trump got elected, he attracted a bunch of money from overseas the taxation reduction for big companies bringing their money back. So there was several $1 trillion in capital that came back to the United States, which really started the economy up because that money has to go to work. Big companies were able to bring money back to stimulate the economy. It stimulated the economy. And then when COVID hit, then now you've had the supply chain slow way down. And then the stimulus that the government's doing is actually creating too much money in the marketplace. And that's too much money is chasing too few goods, which is why this inflation is happening. Their argument right now is that it's called transitory inflation, which means that this inflation is just happening because of the supply chain issues. A year from now, when the supply chain issues are gone, then that inflation level will actually settle back down. Most people that I know that are in the investing world do not believe that it's really transitory. They believe that these prices are this inflation is going to be here forever. Meaning not the rise in the inflation, but the $200,000 purchase price is now somewhere between $300,000 and $400,000, and that it's not going back to two. So that $200,000 house from 2015 that's now worth 3.25 is never going back to 200. And so that inflation actually exists in the marketplace, and that's why there is so much of a shortage. Now, what does that mean for you and I? I actually believe, and I've talked to a lot of other investors, including in the national group, I believe that we're at a shortage that is going to take somewhere between 5 and 7 years to build out of. That means that we dig holes as fast as we can over the next 5 years, and it is going to, we won't be able to keep up. If you want to just go look back at your own market and what you're looking at, go look at what houses were selling close to what you're looking for even a year ago, and then go look at it from what it was in 2015, and then go look at it from like 2008. And you'll see that there is a substantial change, and there's a substantial change of inventory. So let me talk to you about what's inventory is happening in our local market. We were experiencing about 600 to 800 houses on the market in La Crosse County, which is where we do most of our new builds and most of our flips. La Crosse County, Wisconsin, it was 600 to 800 houses on the market on average. When the market slowed way down, it slowed down all the way. It was about 20. It's about 2 year delay from the crash. So about 29 to 2011, and at the height of it, height of the market crash in our county, there was about 1,200 houses on the market at any given time. In the last year, that number has dropped to 80. And by speed of the market right now, when you look at the MLS, there's 80 houses in the MLS, but 40 of them are under contract immediately. So there's really about 40, and that would be about, if you're counting 600 to 800 houses, you're at 8 to 10% inventory. But lately, there's only been about 40 houses in the MLS. Now it does jump up and down because there's houses that are listed regularly, and then we have seasonal behaviors. So like our winter months are the slowest time of year. The fastest time of year is right when it turns green in the spring, and then there's another push right before school starts around August. But right now, because of the shortage, houses are still going off. As a matter of fact, more houses have sold this year in La Crosse County than I think in the last year and a half, 2 years combined, but the inventory still sits low. So that's part of like the way the market works, is like there's a lot of inventory and there's speed, and the speed is so fast right now that it's holding the inventory down. But even the inventory being low doesn't mean that the house comes on and goes off. So there's more houses being sold, but you can't see them because they're coming on and off the market too fast. Because of that, that's where we're at as in the shortage. And so right now, in almost every market now, like I said at the beginning in that disclosure, you need to look at your own local market, and you need to pay attention to your own local market, because there are differences in markets and there are differences in price points. But when you go look from market to market, the percentages are relatively similar. So if and we talked about this in a previous one, but there is a direct correlation when you look at, everybody reports real estate. The national media reports real estate nationally or globally even, but nothing really happens you can't really look at a market from a national perspective. You need to look at it from a local perspective. Within a local perspective, you have a very nice area almost always, and a very poor area. La Crosse County, they call the poorest area war zone, because where like a lot of crime happens and bullets are flying. The war zone in La Crosse is very, very not crime. I mean, it has some crime, but not near as much as bigger cities. So Midwest is different than bigger cities. But when you look at the national market, Vegas, Florida, and Arizona are the three fastest growing markets, but they're also the biggest crashing markets. And Vegas is the fastest crashing market, primarily because of the fact that it is Sin City, and people, when they are afraid of where their next meal is coming from, do not go and gamble. So it slows down Vegas the fastest. And then also Vegas would have the biggest crash factor, and it was about 70% in the 2008 crisis. And so if you want to really pay attention to like what's happening in my own market, you can actually tie what happens in Vegas on a timeline scale. So go back to 2008, when Vegas crashed, go look at when Vegas began to start to crash, and then when did your local market start to crash? And that is the period of time that it takes for you to get an opportunity to recover if Vegas crashes again. Now, all things being equal, it's still going to be off in its averages, but in general, like La Crosse market is 2 years behind Vegas. It's about a year and a half behind Arizona and Florida. And Arizona and Florida are about 6 months behind Vegas. Florida is actually stronger than Arizona because of it being a no state income tax market. And by the way, that is one of the hugest drivers of where the explosion in real estate is happening right now. So if you're looking at a national level, the states that are without a local income tax are attracting the most people. On a national level right now, there is a migration happening. As a matter of fact, California, I think New York, both just lost congressional seats because their populations have decreased enough to cause it. Texas and I think Florida both gained seats. Texas is a no state income tax state. Florida is a no income tax state. Tennessee is a no income tax state, and there's a couple other, I think there's either 9 or 13 of them. But those are the three right now that have the biggest booming. Nashville, Tennessee is experiencing a growth factor that is insane. Florida's is off the charts as well. I was just in Jacksonville last week, like I said, at a meeting, and they are having situations where they will open a subdivision of like 40 to 80, and they will be sold, not the lot and the builder, and now they got to wait a year after the builder, because the builder can't build them fast enough. Like there's legitimately like the entire subdivision sold, and now they're just waiting for the builder to catch up. It's that far behind. So the opportunity right now is that we're in a growth phase, and investing now is really one of the stronger situations. What would turn that around? Well, first of all, I told you about looking at the different markets that come down first as your measure to see if your market is in trouble. If you're like I said, La Crosse County, we not only have because we're in the Midwest, we have less crash. We have a 2-year delay, but we also have like I said, Vegas lost about 70%, Florida lost 50%, Arizona lost somewhere between 45 and 55% of value, meaning a $500,000 house, if you lost 50%, it's now worth $250. In Vegas, there was stuff that was worth $400,000 or $500,000, went to like $125,000. So that was a big, huge jump. My market in La Crosse, one of the benefits is across the average loss in La Crosse County was only about 10%. So knowing what your crash factor is as well is a big deal. The other thing is because we're so close to 2008, you will hear people in the marketplace constantly, oh no, we're in a bubble, we're in a bubble, we're in a bubble right now. Technically, we're always in a bubble because money and these investments actually operate very similar to water. And if you look at the way a wave comes in, the movement of the wave is always right there in the front. That is the bubble. Knowing whether the bubble is up or down is where you need to worry about your investment context, because you can make money. As a matter of fact, most wealth creation actually occurs in the down market. It's the ability to capitalize on the failed deals that creates the most wealth. but you can make money in real estate in any market if you know where you are and how you need to behave in that marketplace. And that's really why we're looking at why there's such a shortage. This shortage could be offset, and the only thing I really can see that would offset it is an international, like World War III scenario, which I don't believe we're close to. There is all kinds of stuff that goes on in the world market or the world politics that's crazy, but going to actual physical war is a bigger deal now than ever with how big the world population is. So that would be the number one thing that could cause a housing crash right now. I just don't see anything in the future, and I'd love to hear your comments if you agree or disagree with me on this. If anybody disagrees, put it in the comments that they think I'm insane, because I'd love to hear anybody's explanation of where I'm wrong on this, because of how much of a shortage we really do have. The good news is, and this is one of the reasons we do this as well, this meeting, is we offer our investors a great opportunity to invest with us. And our baseline right now is 5 points and 7%. And so what that means is the amount of capital that comes across the closing table gets 5 points or 5 percentage points added to it. So all of our deals right now, our building deals are in La Crosse County, like I told you earlier, and we use private lenders to invest in these deals. And so on a $500,000 investment, and I'm going to go over one before the end of the call, but a $500,000 investment would get $25,000 added to it at the closing table. So what that means is $500,000 comes in, there's a note and mortgage attached to a physical deal. The loan to value amount is always 75% or less, because our percentage of profit is above and beyond that 75%. And then from there, that money comes across the closing table. We add the 25,000 to the 500,000. So the note face value of the mortgage, if I paid you back on day 2, I'd automatically have to pay you the 25,000. That's what the points, that's what the 5 points mean. And then on a 360-day return, you get 7%. So the reason we do it that way is because we're basically paying 12%. And because you're making 7% on the 5 points as well, it ends up being 12.35% return. But the reason we're doing it that way is because our goal is to actually turn the money more than once a year. And when we get to turn it twice a year, instead of it being 5 points plus 7% equaling 12 or 12.35%, it actually is 5 points for the first deal, 5 points for the second deal, because we attach it each time. And the 7% gets added as well. So it's 5 plus 5 plus 7. So it ends up being more like 70%, 17%. It's actually a little bit over if it's a full 2 deals in 1 year. The reason we're doing it that way is because we're trying to reward the investor for coming back over and over again. They get a better deal for our success, lends them success as well. The deal that we're looking at today is actually a 4-plex. The capital needed for the investment is $970,000. I'll show you the picture of it. That's what it looks like. This will be sold off in 4 separate units. So when the deal's done, when the project is built out, it'll be worth $1.4 million on all 4 units. And then the 5 points, $970,000 is what it takes to build it. The 5 points added is $48,500. The total of the gain, the 360 gain, is $119,000. No, the 360 gain is $71,295. So the total gain for the year is $119,795. The loan to value ratio on that one is, see it here. LTV is 69.29%. So like I said, we're below 75%. If you're interested in a deal like that, you're welcome to reach out to me on my cell phone at 608-306-1199, or you can reach me at joshua@realestateinvestmentresults.com. And love to talk to you about investing in that deal. The desire is to have a longer conversation with investors to actually kind of teach some of the stuff that really drives the market and really gives us an opportunity to have more conversations. Thank you for joining us today, and we hope you have a great rest of the week. And like I said, we'd love to see you next Tuesday as well. with any questions or any concerns, or even ideas for topics to discuss, because we love talking about real estate and investing in general. Thank you for joining us, and have a wonderful afternoon.